Suppose an investment gains 50% one year and loses 50% the next. Its average return appears to be zero, but $100 has fallen to just $75. That single trap explains why investors can celebrate impressive-looking returns while quietly losing wealth and purchasing power. In this lecture, we uncover what an investment truly earned and what the headline return may be hiding. We are going to study how investors measure investment returns and historical performance. This topic is one of the foundations of investments. Before we can compare stocks, bonds, portfolios, funds, managers, or benchmarks, we need a clear way to measure performance. Return is the language we use for that comparison. At first, return may sound simple. Did the investment make money or lose money? But in finance, we need to be more precise. We need to know how much was gained or lost, how that gain compares with the amount invested, whether the return came from price changes or cash income, and whether the performance should be interpreted over a short horizon or a long horizon. We also need to distinguish between returns that look good in dollars and returns that truly improve purchasing power. Inflation, compounding, risk, and the time period all affect the story. So in this video, we will build the topic step by step. We will start with basic return measurement, then move into holding period returns, return components, compounding, arithmetic and geometric averages, nominal and real returns, risk premiums, and finally the careful interpretation of historical performance. By the end, you should be able to look at an investment return and ask the right finance questions, not just react to the headline number. Let's begin with the most basic idea. An investment return compares what an investor receives with what the investor committed at the beginning. There are two common ways to express performance. The first is dollar return. The second is percentage return. Dollar return answers a very direct question. How many dollars did the investor gain or lose? It looks at cash received from the investment plus any change in the value of the asset. If the asset pays income, that income matters. If the asset rises or falls in price, that change matters too. Percentage return answers a different question. How large was the gain or loss relative to the initial investment? This distinction is extremely important. A dollar gain may sound large, but it may be small relative to the size of the investment. Another dollar gain may sound modest, but it may be very impressive relative to the amount originally invested. That is why finance usually focuses on percentage returns. Percentage returns normalize performance by investment size. They allow us to compare investments that have very different dollar amounts. For example, a portfolio manager, an individual investor, and a pension fund may all invest very different amounts. Dollar gains alone wouldn't allow a fair comparison. Percentage returns make the comparison meaningful. So, whenever you hear that an investment performed well, the first question should be, performed well relative to what beginning value? Now, let's focus on the holding period return. The holding period return measures the total return earned over the exact period for which the investment is held. That period could be very short, very long, or anything in between. The key idea is that the return belongs to the actual holding period. This return includes the full economic benefit received by the investor during that period. If the asset pays cash income, that income is included. If the asset changes in value, that price change is included. The holding period return combines these pieces into one total performance measure. For stocks, cash income may come from dividends. For bonds, it may come from coupon payments or interest. For real estate, it may come from rental income, after considering the relevant cash flows. For other assets, there may be no interim cash income at all, and the return may come entirely from the price change. One important warning: a holding period return isn't automatically annualized. A return over a short period isn't the same thing as the same stated return over a long period. The time horizon matters. When analysts compare returns, they must either compare returns over the same horizon or convert them to a common basis. This is one reason investment performance can be misunderstood. The return number alone isn't enough. We must always ask, over what holding period was this return earned? A total return can be broken into two major components, the capital gain return and the income return. The capital gain return comes from the change in the price of the investment. If the asset becomes more valuable, that creates a capital gain. If the asset becomes less valuable, that creates a capital loss. The income return comes from cash paid by the asset during the holding period. This could be a dividend, interest payment, coupon payment, distribution, rent, or another cash flow received by the investor. Together, these two components explain the total return. This breakdown is useful because different investments create value in different ways. A growth stock may generate most of its return through price appreciation. A dividend-paying stock may combine price appreciation with cash income. A bond may generate a substantial portion of its return through interest payments. A real estate investment may combine price changes, rental income, and expenses. Let's think beyond the total number. Let's ask where the return came from. Was it mainly from a rising price? Was it mainly from income? Was the income stable or uncertain? Was the price change driven by fundamentals, market sentiment, interest rates, or risk conditions? This decomposition helps investors understand not only how much they earned, but why they earned it. And that why is often more important for future decision making than the return number itself. Now, let's move from a single holding period to multiple periods. When an investment is held across several periods, returns compound. Compounding means that each period's return affects the base on which the next period's return is earned. This is a powerful idea. Investment performance over time isn't just a simple addition of returns. The path matters because gains and losses change the level of wealth as the investment moves through time. If there are no additional cash contributions or withdrawals, the order of returns doesn't change the final cumulative return. But volatility still matters deeply. Here's the intuition. A gain and a loss of the same stated percentage don't perfectly cancel out in wealth terms. Why? Because after a loss, the investment is working from a smaller base. To recover, it needs a larger percentage gain than the loss that created the decline. This is why volatile investments can have an average return that looks attractive, while the actual compound growth experienced by the investor is much less attractive. Compounding is central to performance measurement because investors ultimately care about wealth accumulation. They care about where they start, where they end, and what happened along the way. So whenever you evaluate a multi-period investment record, don't stop at the average return. Ask how the returns compounded into ending wealth. This brings us to arithmetic average returns. The arithmetic average return is the simple average of returns across periods. It answers a very specific question: what was the average return in a typical period? This measure is useful when we are thinking about a single future period and treating historical returns as observations from a return distribution. In that context, each period's return is one observation, and the arithmetic average summarizes the typical observation. But we must be careful. The arithmetic average doesn't describe the compound growth of wealth over multiple periods. It doesn't tell us what constant return would have produced the same ending wealth. That distinction is essential. The arithmetic average can be helpful for estimating an expected return for a single period. But if we use it to describe long-term realized performance, it may give a misleading impression, especially when returns are volatile. A portfolio with highly uneven returns may have a strong arithmetic average, but the investor's actual compounded wealth may grow at a lower rate. The gap appears because volatility reduces compound growth, so the arithmetic average isn't wrong. It is simply answering a particular question. In finance, a measure is useful only when it matches the decision. Use the arithmetic average when the question is about the average return in a typical single period. Don't automatically use it to describe long horizon wealth growth. Now let's discuss the geometric average return. The geometric average return is the constant return per period that would produce the same ending wealth as the actual sequence of returns. This is the key phrase, same ending wealth. That makes the geometric average especially important for describing realized compound performance over multiple periods. When investors look back at a long-term track record, they are often asking, what steady return would have created the same result? The geometric average answers that question. The geometric average is usually less than or equal to the arithmetic average when returns vary over time. The two are equal only when returns are the same in every period. As volatility increases, the gap between the arithmetic average and the geometric average tends to become larger. This is one of the most important lessons in performance measurement. Volatility doesn't just make the ride uncomfortable, it can reduce the rate at which wealth compounds. So, when should we use each average? Use the arithmetic average to describe an average single period return or to help think about a one-period expectation. Use the geometric average to describe realized compound performance across multiple periods. Neither average is always better. The correct choice depends on the question. A good analyst doesn't ask, which average do I like? A good analyst asks, which average answers the decision problem in front of me? Next, let's distinguish between nominal returns and real returns. A nominal return is the return stated in dollar terms without adjusting for inflation. It tells us how much the number of dollars changed. A real return adjusts for changes in purchasing power. It tells us how much more or less the investor can actually buy after accounting for inflation. This distinction matters because investors don't ultimately care only about dollars. They care about what those dollars can purchase. An investment can have a positive nominal return and still reduce purchasing power if inflation is high enough. In that case, the investor may have more dollars at the end of the period, but those dollars may buy less than before. That is why real returns are important in long-term planning, retirement analysis, asset allocation, and performance evaluation. A return that looks acceptable in nominal terms may be much less attractive after inflation. There is an exact relationship between nominal returns, inflation, and real returns, and you can see that relationship in the visual. There is also a simple approximation that is often used when rates are moderate. But when precision matters, the exact relationship is the better tool. The main idea is simple. Nominal return measures growth in dollars. Real return measures growth in purchasing power. A strong investment result shouldn't only increase the account balance. Over time, it should help preserve or improve what the investor can actually consume. Now let's talk about risk premiums. A risk premium is the return above a benchmark that compensates investors for bearing risk. In many investment settings, the benchmark is a short-term risk-free or low-risk interest rate, such as a treasury bill rate. The idea is straightforward. If investors can earn a relatively safe return, then a risky investment must offer the possibility of additional return to be attractive. That additional expected compensation is the risk premium. We need to distinguish between expected risk premiums and realized risk premiums. The expected risk premium is forward-looking. It is what investors require or anticipate before the investment outcome is known. The realized risk premium is backward-looking. It is what actually happened after the period ended. These two can be very different. A risky asset may have a positive expected risk premium at the beginning of the period, but deliver a negative realized risk premium by the end. That doesn't automatically mean the original investment decision was irrational. Risky assets can disappoint precisely because they are risky. This is a central idea in investments. Higher expected return isn't a free gift. It is usually connected to uncertainty, potential losses, lower liquidity, sensitivity to economic downturns, or other forms of risk. So, when evaluating performance, ask, return above what benchmark? And was the premium expected, realized, or both? That distinction helps separate good decision-making from good luck, and poor outcomes from poor reasoning. Finally, let's interpret historical returns across major asset classes. Historical performance is useful because it shows how different investments have behaved across many market environments. It can reveal the long-run trade-off between risk and return. Riskier asset classes have often delivered higher average returns over long horizons, but they've also exposed investors to larger losses and more difficult periods along the way. However, history must be interpreted carefully. A historical average isn't a promise. It is a summary of what happened in a particular sample, during particular economic conditions, using particular definitions and measurement choices. Several issues matter. The sample period can change the conclusion. Survivorship and selection can affect the data. Inflation can change the interpretation of nominal returns. Taxes, fees, spreads, and transaction costs can make investor returns different from reported index returns. Drawdowns matter because investors must survive the path, not just admire the destination. We also need to remember the difference between arithmetic and geometric reporting. A high arithmetic average may overstate the compound growth actually achieved by investors. The main lesson is this: return measurement must match the decision. Are we measuring a single period expectation, multi-period compounding, purchasing power, excess return relative to a benchmark, long horizon wealth accumulation? Each question requires the right return concept. Thank you for joining me today. I hope this lecture helped make investment returns clearer, more practical, and more useful.